Welcome, I'm Jessie CHAHAL. You're watching The Nation. As geopolitical tensions flare from the Middle East to Eastern Europe, financial markets are once again on the edge. For open economies like Malaysia, distant conflicts can quickly ripple through the system, influencing the ringgit, commodity prices, and even the confidence of global investors. Well, lucky for us, today in the studio, we're joined by Professor Dr. Joseph Cherian, CEO and Dean of the Asia Business School, to help us break this all down and really give meaning towards what this means. Welcome, Prof. It's good to have you here with us. When we look at global conflicts and how that's shaping Malaysia's market, let's first talk about the bigger picture. Recent tensions in the Middle East and, of course, with the US and Iran in terms of their relationship at this point. What's the first thing businesses should be noticing?
Okay, Jessie, I will tell you from the finance perspective, because I'm a finance man. The first thing I would do if I was a businessman is to look at what financial markets are telling you. So I go to financial markets, tell me what's the risks out there. So there are certain indicators we can use, like implied volatilities. It's a form of measure. We don't have to know the mathematics behind it, but it tells you how risky is the market from the people's point of view. So on average, it's about 14%. It tells you that the market is on average a risk factor of 14%.
Can you simplify that for us to really give us a better lens into it? How do we break this down?
Okay, implied volatility is about the uncertainty in markets. So if there's a war, if there's geopolitical tension, there's trade wars, the risk goes up. So it's an indicator of risk. So if I say the number is 14% historically, and now it's 32%, that means it's gone up a lot. That means uncertainty about markets have gone up a lot, which means you better bring out your defenses. So you need to look at indicators of marketplace. One is implied volatilities. The other is credit spreads. Credit spreads is what bank companies borrow at. How much is your premium, that means it's the cost of borrowing, above the, let's say, your riskless rate, which is the treasury yield. So that premium has also gone up. What does that say? A corporation has to borrow, and yourself too, if you're going to get a mortgage or a car loan, that cost of borrowing has gone up. We look at that spreads as well. These are all available in the markets. The recent tensions have caused those numbers to go through the roof. That's not a good sign.
Right.
That means the world thinks, hey, you better think about this whole thing. It's not just the wars, there's also the tariff thing that's compounding the problem.
Right.
So their world is saying, markets are saying, there's a problem here. We may not fully agree with what's going on. And
what is this indicative of in the short term and, of course, long term?
That means the risk of investing, the risk of things going out of control is going up. The uncertainty is going up. So your risks, whether it's your own portfolio, whether it's your corporate portfolio, those risks are going up. So the market's telling us it's going up.
Right. So how do these events travel from a conflict zone, and how does it then translate into danger zones for us here in Kuala Lumpur?
In Malaysia, well, the numbers for Malaysia has also gone up. If you look at it, the yield, the cost of borrowing for Malaysia has gone up. It's gone up a bit. It's now, let's say, the 10-year borrowing rate. Okay, you're a corporation, you want to borrow. I would say you're a government, you want to borrow. It's at about 4.2%, the borrowing rate. Just think of it this way. The higher the borrowing rate, the more costly it is for you. It means it's more difficult to do business, whether you're a government, a corporation, or personal basis. It's costly. So as long as the yield goes up, that's not good. Those yields have been going up in Malaysia as well. The market, equity market, we all know about equity markets. The Bursa Broad Index has dropped about 1%. It's about the rate at which the S&P has dropped. But if you look at the lower caps, the smaller caps, the newly emerging companies and technologies, it's down 11% from the high. So that's a big drop. So it affects us for sure. We are not insulated from that.
Can you take us back to a time perhaps in the recent past, or where there was a past conflict, and how Malaysia's markets bounced back or even reacted?
Okay, so we are highly correlated on most occasions, not always. On most occasions, we follow the US market. The whole world follows the US market. You have seen in all the conflicts, from the Kuwait war, from COVID-19, global financial crisis, US markets dipped, Malaysian markets also dipped, in an almost uniform fashion. But the good news is all these markets, including Malaysia, recovered nicely. So there's no guarantee it will, but usually as soon as the conflict gets resolved, and hopefully this conflict, it looks like they're coming to some terms, I'm not sure, things can again blow up. If they come to terms and they start smoking the peace pipe, I bet you the market's going to recover on average. So,
and how long will that take roughly?
It depends how fast.
Back?
So the market's always ahead of you.
Right.
That means they are watching the signals and reading the tea leaves.
And as we speak about signals and reading the tea leaves, which are some global indicators that are the clearest early signals or signs for local impact?
Okay. For local impact, you can still look at global indicators. As I told you, the implied volatility, it's called the VIX. You may want to look it up too. VIX is an indicator. As soon as it starts dropping down to normal levels, you know that the market's signaling, we think this is a credible, believable peace that's coming in between the warring parties. So we look at implied volatilities. Do credit spreads. Remember I told you the borrowing rate? How much higher is the borrowing rate? You will also see that coming down. Anytime you see these things coming down, that's a signal that we'll also do well. Now, of course, some things benefit us. The price of oil going up has benefited our economy in past historical episodes. We benefited from that because our oil is of very high quality oil and we benefit from the higher prices. But don't forget, we also use oil, fossil fuels as an input to the production process. So companies that manufacture and export, that use power and all that stuff, they're going to have a hard time.
Right, I'll come to oil prices in just a minute, but just to give a better picture and understanding of VIX, that's a bond and sukuk information exchange.
No, VIX is traded in the US. It's a volatility index that talks about the uncertainty. So the higher the VIX, like it was 31% just a day or two ago, which is abnormal, it's very, very high. But it has been that high when we had the global financial crisis. So you can have such episodes where the VIX rises up. So that's one indicator. The other is credit spreads. These are all available. If you just Google, it'll come up with a credit spread.
Right.
That means how much is your borrowing cost as a corporation or as a personal loan? How much is your borrowing cost? If that's going up as well, that's a warning sign that it's a lot of uncertainty in the market. But once it starts diminishing, you know that there's some credible peace that's coming about.
Right, just wanted to get clarity on VIX because there's also a Malaysian sort of approach or a term where the bond and sukuk information exchange.
Correct. There's also the bond and sukuk market. So if you look at it, it's good you asked that question because it's very interesting. I've been observing those markets. So as I told you, the Malaysian government security yield for the 10-year, that means if government's borrowing at 10 years, it is at about 4.2%, I think, if I'm not mistaken, or 4.2%, if I'm not mistaken. But it's a bit elevated. But the sukuk usually trades at a higher yield, everything else held constant. Okay, so a government issues sukuk, 10 years, and it issues Malaysian government securities. It's the same government, same credit rating. One is sukuk, the other is regular conventional bonds. But the sukuk normally trades at a lower price. When the yield is higher, the price is, when your borrowing cost is higher, the price is lower. It's less rewarding. So the sukuk on average trades at a lower price than Malaysian government securities. But it flips whenever there's a political crisis. And I looked at the market just yesterday, the sukuk is now trading higher, dollar for dollar, higher than the conventional. It happened during the global financial crisis as well. Right. This is a very interesting phenomenon for Malaysia. If you're a corporate or a government, actually during times of crisis, it's better to issue a sukuk than to issue the conventional bond.
Point to note right there. Now, oil has crossed over the $100 per barrel point. That was last seen in 2022. Then it dropped sharply to $81 US. Will there be, or rather, what will be some of the implications of such a price movement on the Malaysian economy as well as ASEAN, if we look at it from a broader perspective?
Yeah, certain countries are affected more. We, fortunately, have our own oil. Korea, Thailand, Indonesia, they don't have sufficient oil, they have to import. So they are being affected a lot more. You can already see warning signs at the pumps. People are panic filling up. You don't see any people lining up to pump in Malaysia because we know we have enough oil. There's some ways in which we can substitute and stuff like that. But certain countries, including Singapore, may face a shortage because they have to import the oil. Now, that said, I do think oil prices have started coming down a little bit, which indicates that maybe it's not as serious. But one thing that people underestimate, at least in America, and I think it's also true in Malaysia, is the cost of living. Oil has a direct impact on the cost of living because it's used in almost everything. So even when you make a battery, you need oil, fossil fuels to create the batteries and stuff. You know, you need power. So my point is that it will invariably lead to higher inflation. So we have to watch out for that.
But at this point of time, you are seeing signs or signals that it could go back to some sense of normalcy.
The oil, yes, it's going down, but you know, this is very unpredictable. It's very volatile. You know, I told you volatility is uncertainty.
True.
So it could go back up. All I'm saying is the long-term impact is that it's going to affect our cost of living because there's a triple whammy for Malaysians. There's a triple whammy. Oil prices, which affects the cost of production, which means our price of goods will go up. Right. Despite the fact that we don't have to worry about pumping if there's enough oil around for us. The second is the tariffs. It's causing disruptions in the supply chain. And of course, the third is this consideration of ringgit. How ringgit, well, for good or not, it's at quite a high. And that's increased the cost of manufacturing and stuff.
How has the ringgit been, I guess, for 2026 itself? How has it performed?
It's performed, I mean, it dropped a little bit. So it's weakened a bit because of the flight to quality. So whenever there's geopolitical risk, everyone moves their assets to America. So because of that, the demand for ringgit goes down, for US dollar goes up. So the US dollar has recovered a bit. But on a one-year basis, the ringgit is up 26%. We should all be celebrating, you know. That's a good thing. The ringgit makes it easier for me to travel, you and me to travel, to buy overseas imported goods and so on. But the problem is it becomes more costly to export. And you know, we're an export-driven economy. Our semiconductor industry, our agriculture industry, palm, it's becoming more expensive to export. So that can impact us. And then you have, on top of that, the supply chain disruptions. Getting the product out to different parts is being disrupted.
We speak about supply chain and impact. Overall, what should Malaysian businesses be paying attention to at this point to stabilize and to have some certainty despite the uncertainty
Good question.
before us?
See, when I teach finance, financial markets is no different from manufacturing and all the other industries that we're in. In financial markets, we always say prepare for the worst. That means have some scenarios that you can plan for. What we call is Monte Carlo simulations. Basically, when you do Monte Carlo simulations, you find out, what do I do in the worst case scenario? Now there's a big thing. In fact, one of my colleagues is the leading scenario planner. You may not believe this, but he's right here in KL, and he was doing some interviews today. How to plan for scenarios during uncertain times where there's no past scenario that you can draw on.
To benchmark against.
To benchmark, exactly. See, Monte Carlo simulation is what we use. We have data. So we can run the data through all kinds of randomization routines and come up with potential optimal solutions in the different scenarios. What if you don't have data? It's a totally new world. Right. We have totally new leaders who are doing all kinds of crazy things. How do we act? That's called scenario analysis. So you've got to plan for those various contingencies. So if I was a board member or leader, I would take a course in scenario planning and say, how do I adjust my business and make decisions under these different unheralded, unexpected scenarios that we are facing?
Give us a quick 30-second masterclass 101 on this. What would be the main principle of the Monte Carlo simulation? How could we apply it?
Okay, so the Monte Carlo simulation is something we do in finance. Basically, we look at the historical data over multiple business cycles and economic cycles. You can't do it over a short period. It must be over a long run. I must have the Kuwait Gulf War. I must have the global financial crisis, the Asian financial crisis,
You're
COVID.
Looking at 20, 30
years. We take the data. What we do is we look at the data and you run it through some kind of randomizing. It's a mathematical tool, but don't worry, that tool, you can do it in Excel. You know, even anyone who knows how Excel, you can do it. You randomize the data and see what are the potential good outcomes, median outcomes, and bad outcomes. So you know that it's an average, that bad outcome is an average of all the bad outcomes. That's Monte Carlo simulation, using historical data and then creating some uncertainty around the data so that you can prepare for the worst case scenario going forward. Scenario analysis is slightly different. I'm not the expert in scenario analysis. I told you my colleagues are leading experts in the world on this. Basically, you don't have the data, you don't have the models. How do you think strategically, agilely about the different ways in which this could happen? What if the ports in the Middle East are all blocked? You can't get oil out. What do you do? Do you find alternative supply chain and stuff like that? So basically, it's more about qualitative, not so much quantitative, qualitative thinking about how you can adjust your supply chain. You know, there's some companies who do this, you know, they actually have this. Singapore is one example. When COVID hit, they started sourcing their meat and vegetables from all over the world, Brazil, Australia. Previously, 90% of the chicken of Singapore came from Malaysia. So COVID taught them that they've got to plan for a scenario where the land border is closed. You can't get the chickens across. You have to go to other countries where you can get it. So it's a bit of diversification as well to your supply chain. So that's a pretty good example of scenario planning.
Of crisis planning as well, despite not having a previous incident to benchmark on. Now let's look at the global shock effects of an investment fund or a local portfolio. Perhaps you could walk us through in terms of what that is like, or what steps is needed there.
So we have what's called, you know, I always tell people, don't start moving your portfolio around and panicking and all that. Have a long-term view and keep that view. So let's say you're a mutual fund manager. That means you're a professional manager. If you get too cute, also it's a problem. But at the same time, you've got to adjust to the circumstances. Let me give you an example. What are the sectors doing very well during this current period because of the tariffs and the war and all this uncertainty? Energy sector is doing very well. The defense sector is doing very well. Materials and industrials, because people need solid, you know, machinery and all that for, you know, given the circumstances, they need all this stuff. Those sectors are done very well. Energy is up 24% year to date. In terms of, now, what if you didn't invest in the energy sector? You'd be behind. So what we call it is tactical allocation. If you're an investment fund, you should tactically rotate your portfolio to overweight the ones that are benefiting from the geopolitical situation or trade wars or whatever. So the fund managers usually have experience to do that. And if they were invested in, say, cyclicals, technology, those things are actually down a lot. So you have to be careful. You don't want to get caught up in the sectors that are not doing well and be leaving out the sectors that are doing well during these geopolitical tensions.
Right. So again, to simplify that, where does that leave us in terms of understanding where the safe zone might be, or where would be a sweet spot?
Okay. If you're an average investor like you and me, just leave it to the managers, the professionals to do it. I'm talking about the professionals. They have to technically overweight, because you think about energy sector, it's up 24% year to date, and the market is down 4.3. Remember I told you the market is down 4.3%, and energy sector is up 24%. So if you didn't put a bit more weight into energy, or let's say you just never invested energy, you would be left out a lot. So you would hope to put it into a fund as a retail investor, as an ordinary investor, whether you're doing it through your EPF or whether you're doing it through your wealth management portfolio. You want to invest in fund managers who have a track record of delivering good returns irrespective of the market cycle. And there are managers out there who do these tactical, not too much of it, but who do this. So my recommendation is don't try to do it yourself. If you're not trained in finance, I have a PhD in finance and I still try to stay away from all these kind of tactical decisions for my personal portfolio.
Right.
I leave it to the professionals, and that's what I'm talking about.
And so based on that, what should we be looking at every day in terms of the market, and is there particular things that we should be monitoring?
Yeah, so first of all, make sure you're invested. Don't panic and start withdrawing, because you can never time the market perfectly. The second thing is make sure you understand what's going on. So you've got to read and get financially literate. You don't have to be a fund manager, but at least be literate, like I told about this volatility. It's very simple. Look at the VIX. You look at the average and you look, it's gone up above average. Hey, something's going on. There's a lot of uncertainty in the market. What should I be doing? Should I talk to my fund manager? Should I talk to my advisor? So I would say these are signals for you to say, should I revisit my portfolio?
For someone who does not have a portfolio yet, is this a good time to start?
Any time is a good time to start. As I said, it's very hard to time the market. But first, let me advise you, put all your money in EPF first. you know. Don't
the safest.
be the safest. It's got incredible 6.3 or whatever, 6.15% in the last cycle. I mean, that's a really safe, good return. I would say that first start there and you get the tax benefits.
Right.
You know, so first of all, put in the EPF. I know they've got something called the account 3, but don't be tempted to start withdrawing from account 3. Keep it there. Let it grow for the long term. And the EPF does a good job of doing the tactical. I told you, they do the tech, because they're professionals. They now do that. Anything above that, I would say start thinking about doing it step by step. You can put aside a bit of money into a low-cost fund. That's what I recommend always. Don't go for the high-octane, high-fee fund. Look for the low-cost funds. And there are many funds. I'm not going to promote any names. Just have to look for low-cost funds on Google. You'll see who are those funds. They have them in Malaysia. It's a globally offered. And pick those funds to start putting small amounts in.
Based on your experience, Joe, and from an investment perspective, what's a smart approach to navigate during this uncertainty?
I would still say do your job well. That means focus on your own work. If you're a dentist, continue drilling teeth. Don't start worrying about which stocks and, you know, leave that to the professionals. So I would say the whole idea is you have to be sufficiently literate to have an intelligent conversation, but you're not making the investment decisions. So I would say that right now, just don't panic and start, you know, people call and say, oh, sell this stock, buy that stock. That's foolhardy.
I'm going to put you in a bit of a spot here, and I know you said it is a time of uncertainty and it'll be hard to predict what's going to pan out in the next few months, but walk us through a plausible scenario over the next maybe 6 months to a year on how local markets might respond.
I would think it's going to be a very tough market. So what I do in these kinds of times, again, I'm going to use some financial jargon, but if you talk to your advisor, he'll know what it means. I would buy high quality stocks. If you're going to invest, look for high quality stocks, diversified, with good dividends, because those are the ones which will be robust to any kind of disruption in the market. So high quality, high dividends. That's the first step. The second step is make sure you're diversified across the asset class. Buy some commodity indices and so on. And again, don't try to assemble the portfolio yourself. To your viewers, if they are not trained in finance, don't try to assemble yourself. Don't listen to rumors. Let the professionals do it, but watch the fee structure. How expensive is the fund you're investing in? So if you have a trusted advisor, you should be able to find a good way to make that investment choice. Another thing I would say is that, you know, you may want to put a bit more in safer assets. The Malaysian government security, as I told you, is yielding 4.2%. That's pretty good.
Right.
Of course, the EPF is yielding 6%.
6%.
So, as I said, first order business, EPF. I mean, of course, if you're super wealthy, you can do whatever you want. You know, you can go by Google for all I care. But I'm just talking about the average investor. Try to start EPF, then low cost, high quality, high dividend stocks in this current period, and then other assets like the Malaysian government security. You can get those indices as well.
Yeah, you did say that the next 6 to 12 months might be a little tough in terms of outlook with the uncertainty. But overall for 2026, where do you leave us with?
Well, I'm telling you something. If they can sort out this whole messy problems out there, including the tariff problem, because fortunately the Supreme Court has ruled in the favor of the rest of the world and said this is illegal, you can't do that. They're trying other means, but it's going to also be ruled illegal because those laws were not set up for this purpose that it's being used for. They were set up for other purposes. That's why the judges are overruling it. So if we can solve the tariff problem, if we can solve the war problem, everyone smokes the peace pipes and gets along, I think we're in for a good turnaround. You know, we are in a good shape with technology, AI on our side. You know, we've got all these tailwinds to push us forward. You know, we just need to get along. You know, I'm going to tell you one more thing, Jesse. The time that the world globally saw the most growth was when Europe, US, China got along in the 80s. That was when we saw spectacular spectacular growth. We saw so many people coming out of poverty in China, in India, in Indonesia, because there's so much inclusive growth.
And do you suggest that that kind
That's
of cooperation is on the horizon?
Of course, no, well, that I don't know. I'm not a politician, but I'm hoping we can all play our part.
Yeah.
Malaysia has played its part in a lot of peace deals. I'm very proud of Malaysia, small country, but we are in the middle of a lot of peace deals. I think we should do that as well, but we can't control the agenda. These big countries have to come to terms. And if they don't understand what's going on, or if they don't want to come to terms, there are ways to fix it,
Yeah.
you know.
So that means 2026 is still looking hopeful, despite the uncertainty at this point. Prof, thank you very much for joining us and coming in here today to shed a little bit more light on the investment and the global markets. Well, in today's interconnected markets, a geopolitical shock thousands of kilometers away can reshape economic expectations right here at home. I hope you found this discussion and conversation fruitful. That's all the time I have for today. Of course, Prof, thanks once again for coming in. I'm Jessie CHAHAL. Thanks for watching The Nation, and keep it locked on to Bernama TV for more conversations on issues that matter. I'll see you next time. Bye-bye.